Good evening, everyone. Now we'll study lesson 10. It is extension of the last unit, working capital. Uh, Lesson 10 is management of working capital. Here we'll discuss about working capital management, cash management, receivables management, inventory management. Aspects of working capital management. If you look into what are the factors affecting working capital, there are 4 factors which affect: cash, debtors, inventories, and creditors. All these management, creditor management, inventories management, debtors management, cash management, they all together form a part of working capital management. Let us go for cash management. Cash is one of the current assets of the business. It is most unproductive of all the assets of the firm, because if you keep ideal cash, it won't give you anything. It doesn't give you anything. In narrower sense, it includes only notes, bank drafts, and coins. In broader sense, it includes marketable securities also. So when we consider cash in the broader sense, it includes marketable securities also. Cash management refers to the management of cash balance, bank balance, and short term. What it means is, cash management means you should not have, whenever you have to meet any debt obligation, then you should have enough of cash to meet that debt obligation. You should have enough of cash to pay the principal and interest related to that debt obligation. But at the same time, you have to make sure that you don't have surplus cash kept with you always, because cash won't give you anything. It won't give you return in the form of interest if it is with you. So it has to be invested in some other form of asset. Otherwise, it won't give you any return and it will lead to losses for you. Now, what are the motives of holding cash? Transaction motive. There can be various transactions: buying of raw material, purchasing of raw material, payment of creditors. These are all transaction motive. Then precautionary motive. There can be precautionary motive in case if something comes for which the cash is required. For that, you can keep some precautionary motive. Then speculative motive. A speculative motive is when you when the motive of keeping cash is something speculative or something related to uncertain change in movement of prices. For example, something invested in shares or something invested somewhere where it is speculation, intraday trading, etc. Compensation motive. Compensation motive means if someone's giving some service to you, you're compensating him. For example, paying wages, etc. Now, next one is factors determining cash needs. What are the factors which determine the cash needs of a firm? Credit position of the firm, what kind of credit days a firm is getting from its suppliers. If it is getting more credit days, then it does not need more of cash. But if it is getting less credit days, then definitely more of cash is required. Status of firm's receivables. How are their receivables? Are people who are taking money, things on credit, are they paying back regularly, or they are defaulting? And status of firm's inventory account. What about the firm's inventory? Are they having sufficient raw material, finished good, etc.? Nature of business enterprise. What is the nature of business enterprise? For example, there are some enterprises which deal in big projects like real estate. There they need more of cash. And there are various businesses which have by custom, they have a lot of cash transactions, so there more of cash is required. The management's attitude towards risk, whether they are more risk taking or less risk taking. Then amount of sales in relation to assets. What is sales to asset ratio? Then cash inflows and outflows. What is cash inflow and outflow? If there is a temporary shortfall of cash, then definitely you will have to go for more of cash in your hand. Then cost of cash balance. In case if you keep cash balance, then what will be the cost for you? If the cost is higher, then you won't keep cash balance. If cost is lower, then definitely you can keep your cash balance. Objectives of cash management. Why we manage cash? Meeting payment schedule. It is very important to meet payment schedule, otherwise it will lead to loss of credit. Minimizing funds committed to cash balances. So also minimizing funds which are required. And to management of credit purchase and sale. So if you have purchased anything on credit, or you have sold anything on credit, and then that management is also the objective. So management of creditors and debtors, to deal with contingencies. If something comes unforeseen, then definitely that has to be dealt. So that's why also we need cash management. Successful takeover, if in case you want there is some takeover you're going to materialize, then that is also very important. In case of commodity prices, if in case the commodity price changes are there, then also the cash is required to manage that commodity price changes, to serve the debt. If in case any you have taken any loan, that the payment of principal and interest of that loan is also be done through cash. Next one is receivables management. Receivables, also referred to as accounts receivables, are debts owed by a company by its customers for goods and services that have been delivered or used but not yet paid for. Receivable management is the process of making decisions related to investment in trade debtors. So receivables are what? They are actually trade debtors. These are the people who have taken goods from your company, and they have not paid you at present, but they will pay definitely. Objectives of receivable management is as a marketing tool for business. If you give more credit period to your customers, they will buy more. Optimum level of investment in receivables. So there has to be optimum level of investment in receivables also. There should not be more of investment in receivables, because more investment in receivables show that your receivables you are not able to recover, and that is also causing loss to you. Now, cost of maintaining receivables. What are the costs? First is capital costs. There are various capital costs. The money which you have if you would have got that money, then you would have invested it somewhere else, so it is leading to interest loss. Administrative cost, the collection cost, the collection agents cost, the cost of keeping account of these receivables. Collection cost, the person who is going to collect those receivables, etc. Defaulting cost, if in case there's some default and there are some receivables which are not coming back, then that cost is also one of them. Factors affecting size of the receivables. What are the factors affecting size of the receivables? Stability of sale. If there is stability of sale, then the stability of receivable will also be there. Size and policy of cash discount. What is the size and policy of cash discount you are giving to your customer? Bill discounting and endorsements. What are the bill discounting, and if you have bill discounting things available with you, then it will cost less of receivables. Terms of sale. What are the terms of sale? If you have liberal terms of sale, then you will be offering more of receivable. You will be having more of receivables. Volume of credit sales. Higher credit sales means higher receivables. Credit policy. What is your credit policy? What kind of credit policy are you offering to your customer? Collection policy. Is your collection policy good or not? If you don't have good collection policy, then your receivables will be on higher side. Collection collected in how much collection have you collected? If you have collected more, then you will have less of receivables, and if you have collected less, then you will have more of receivables. Quality of customers. What are the quality of customers? If you have very good quality of customers, they will be paying you regularly, and you will be maintaining a stable amount of receivable. Importance of receivable management. Increase in the growth of sales. See, receivable acts as an incentive. So why? Because you're offering credit to your customer. So if you offer good credit period to your customer, there will be increase in sales. But in case if you offer a lot of credit period, then what will happen? They won't pay you back, and that will lead to loss in revenue. Increasing operating profit. It will lead to increase in operating profit. Meet the competition. There may be competitors who are giving better credit periods to the customer, then you will have to give better credit period than them to attract more customers. Attracting existing and new customers. Higher investment in trade debtors. You may give higher investment in trade debtors, and thereby making profit by gaining their support and confidence. Then minimize bad debts. You have to minimize bad debts. It's very important. Your collection has to be very strong. If your collection is not strong, you are leading to bad debts, then your money will be lost. Facilitates adequate working capital. Receivable, if your receivables are collected properly, your working capital management goes on proper track. You don't need additional fund. Effective planning and control, if you have effective planning and control with your receivables, then it's very good, and it's definitely going to help you, and you won't be falling short of cash in your future for falling short of working capital. It helps in coordination, so it helps in coordination of various activities in an organization. Inventory management. Inventory is an accounting term that refers to goods that are in various stages of being made ready for sale, including finished goods that are available to be sold, work in progress, meaning in the progress of being made, and raw materials to be used to produce more finished goods. Inventory is generally the largest current asset, items expected to sell within next year. A company has the company has. So whatever is expected to sell within next 1 year is inventory. What are the elements of inventory? Raw material, both direct and indirect raw material, work in progress, consumables, anything like screws, drivers, etc. Finished goods, stores and spares, if anything, like consumables is also like grease and all those things. So stores and spares, if any, then that is also very important. Motives of holding inventory: transaction motive, again, why you're holding; precautionary motive; and speculative motive. Types: sometimes you what is transaction motive? You keep the inventory because you want to invest into raw material, and you want to convert raw material into work in progress into finished good, and then you want to sell it. Precautionary motive: in case if something goes wrong and you don't get raw material in proper motive, then what would you do? That's why you hold more of raw material. A speculative motive: when you hold raw material because you believe that the price of the raw material will go higher in the future, and so that you should keep more of raw material at present. Then what are the types? Movement inventories. Movement inventories are inventories which are moving continuously. Buffer inventories, which you keep as stock of a buffer. Anticipation inventories: in case if anything happens in future, you're anticipating that the sales of something will go high, and then you keep that raw material. Decoupling inventories: there are inventories which are connected to something else, and the sale of that goes high, then the sale of other as well go high. For example, the sale, or if the sale of motorbikes is on higher side, then definitely the sale of petrol will be going higher. And cycle inventories, there are inventories which have some cycle. They are sold in cycle, that this will be sold, then this will be sold, and then this will be sold, and then this will be sold. Independent demand inventories, there are very cement inventories which have independent demand, which don't have demand dependent on some other inventory. Dependent demand inventories are the inventories, the demand of which depends on some other form of inventory or some other thing. And what are the costs associated with the inventories? Purchase cost, the whatever is the cost of purchase. Ordering cost, setup costs, if the order cost which has been, which for example, if you want to order some inventory, then there will be some ordering cost related to it. What will be the cost which will be there for ordering it? And carrying cost means the cost of moving inventory from that place where it is made to your place where you are keeping it. And stock out cost means if in case the stock is out of stock completely, then what will be the cost you will be facing because of a non-availability of any raw material. So that is the cost associated. There are 4 costs associated: purchase cost, ordering cost, carrying cost, and stock out cost. Now, inventory management techniques. The inventory management refers to the process of ordering, storing, and using a company's inventory, raw materials, components, and finished goods. These are the methods: economic order quantity, reorder level, ABC analysis, VED analysis, just-in-time, inventory turnover, inventory control of spares, and slow-moving items. Let us discuss these. So there are 7 types of these inventory management techniques. Economic order quantity: it is in quantity of inventory which can reasonably be ordered economically at a time. Then assumptions: supply of goods is satisfactory, the goods can be purchased whenever they are needed, the quantity to be purchased is certain, the price of the goods is stable. Now, economic order quantity is EOQ, and EOQ is equal to under root 2 DS upon H, and D is annual demand in units, S is cost per order, C is cost per S is cost per order, H is holding cost, that is I into C, and I is holding cost, and C is cost per unit. So this is there. This is the price. If you look into this, the point where minimum total cost and optimal order quantity, here the lowest part of curve of total cost of holding and setup is there, and where these holding cost curve and setup cost curve intersect each other, you form a line, and this is in the x-axis, this is EOQ, economic order quantity. This is a quantity of inventory which can be reasonably be ordered economically at a time. So this is a minimum quantity or maximum quantity which should be ordered. This is the economic quantity which can be ordered at a time. Reorder level, it is that level of material at which new order for supply of a material is to be placed. It is based on lead time demand. The reorder point can be determined by taking into account the following: the time lag between the date of packing an order and the date of arrival of supplies, it is known as lead time. Rate of usage, that is average unit consumed in 1 unit of time, day, week, etc. And safety or buffer stock level, it is simple. Reorder level is a lead time demand plus safety lock. So ordering point or reorder level is a maximum reorder period or lead time into rate of consumption. So you should have that much of inventory that will be used in during that ordering time, and the time to which that in which that that raw material will come to your factory, and you should have minimum of that of stock, and then you can make order at that point of time. And maximum level of stock is reorder level plus reorder quantity minus minimum rate of consumption into minimum reorder period. Minimum level may be alternatively fixed as safety stock plus reorder quantity or EOQ. Minimum level of stock is equal to reorder level minus average rate of consumption into average reorder period. Safety stock is annual demand divided by 365 into maximum reorder period minus average reorder period. Reorder level or ordering level is maximum rate of consumption into maximum reorder level. Alternatively, it will be safety stock plus lead time consumption. Lead time consumption will be annual consumption minus 360 into 360 into lead time. So this is there. Now let us go for ABC analysis. ABC analysis, in this method, the cost of each item is multiplied by the number used in the given period, and then these items are tabulated in describing numerical value order. It is actually, if I'll give you an example of a goldsmith shop. What happens is, in goldsmith shop, there is a gold shop. There are 3 kinds of inventories: gold, silver, and bronze. Now, bronze will be available in larger quantity, but if you calculate the value of the total bronze, it will be far less than silver and gold. Similarly, silver will be slightly less in quantity when it comes to when compared to bronze, but the value of the silver combined with into its volume will be more than what bronze value is. Then if you take gold, then gold will be will be available in least volume, but when you multiply it with the value, then the value of the gold will be highest. So gold will be A category, silver will be B category, and bronze will be C category. So that is how we divide the data, and then most of the safety should be given to A. So inventory optimization in supply chain ABC analysis and inventory categorization method, which consists in dividing items into 3 categories A, B, C. A being the most valuable item, C being the least valuable ones. This method aims to draw managers' attention to the critical few A items and not on trivial many C items. ABC analysis, an inventory categorization technique used in material management known as selective inventory control, based on Pareto analysis 80-20 principle. ABC analysis based on user-defined criteria. So if you look into this, A has a less of quantity but more of value. B has more middle of A and C is having more of quantity but less of value. So this is ABC analysis. Now, extent of control: in A type of item, very strict control is required; in B, moderate control; and in C, loose control. Frequency of order, frequent ordering, once in 3 months, one is 6 months, or once in a year. Lead time, maximum effort to reduce the lead time, moderate effort to lead, minimum effort to lead time. Level of management must be taken off by senior officers in case of A, can be supervised by middle management in case of B, and can be supervised by clerical staff in case of C. Period of review after a month or every 15 days of waste, obsolete and surplus items. Review after every 3 months. So more review should be done of A item, mediocre of C, and less of mediocre of B and less of C. Source of supplies, as many sources as possible for each item. In case of A, 3 or more reliable sources, and 3 reliable sources of each item in case of C item. So you have to find more of sources for A. And follow-up, maximum follow-up is required for A and minimum for others. And safety stocks, very low safety stock is required in case of A and high safety stock is required in C. Centralization, centralized purchasing is required in case of A and decentralized can be done in C. Value analysis, rigorous value analysis is required in A, moderate in B, and minimum value analysis is required in C. So this is A because A is most important, B is more important, C is least important. Now, weight analysis, the degree of criticality can be stated as whether the material is vital to the process of production or essential to the process of production or desirable to the process of production. So, VED is vital, essential and desirable. So, while VED is vital, essential and desirable. V stands for vital, E stands for essential and D stands for desirable. Vital items stand for material without which the production process would come to a standstill. Essential items stand for the material whose stock would adversely affect the efficiency of the production system. However, the production process would not come to a standstill. And desirable items are materials which are required but do not immediately cause a loss in the production. Just-in-time inventory system is a management strategy that aligns raw material orders from suppliers directly with production schedules. Companies use this inventory strategy to increase efficiency and decrease waste by receiving goods only as they need them for production process, which reduces inventory cost. This method requires producers to forecast demand accurately. In the Japanese management philosophy applied in manufacturing, which involves having the right items of the right quantity in the right quality in the right quantity at the right place in the right time. So it is ordering just in time when it is required. Inventory turnover. Now, inventory turnover we have already discussed. Inventory turnover ratio is cost of goods sold upon average total inventory, and inventory conversion period, that is average total inventory, is 360. Inventory conversion period is 360 divided by inventory turnover ratio, that is 360 into average total inventory divided by cost of goods sold. Inventory control of spares and slow moving items. Stores and spares inventory turnover is equal to annual consumption of stores and spares divided by stores and spares inventory. So whatever is the annual consumption, store spares holding period is 365 divided by turnover of stores and spares. So it is similar to inventory turnover what we have for inventory or control of spares and slow moving items. With this, we come to the end of the 10th unit. I hope you all enjoy this session. Thank you and have a nice day.